Hi, I'm Eric.
And I'm Dick. We are the Annuity Guys.
Dick, today we're going to examine, I call it the China syndrome.
The China effect.
Yeah, exactly. What effect is China having on annuities?
Well, and I think that because it's in the news so much right now, the effect that China's having on the economy overall, the indirect effect of that, it does affect annuities. It doesn't affect people who already have contracts in place as much as it does those who are looking forward to moving into annuities, with some of their money. And part of the reason for this is that anytime you have this volatility in the market, this uncertainty in the market, there's this huge fleet of safety. And so it bids the price of bonds up,
Right.
and then correspondingly the yields drop. And right now we're seeing yields dropping below 2% again on the 3-year Treasury.
Yep.
This causes the insurance companies to have to pull back.
Right. When you see that, the short-term Treasury notes up to the 10-year note, so when you look at those numbers and they start to come back, that's when these insurance companies, they start to pull back.
They have to.
And it's all kind of like the chain reaction here.
Yes.
And that's why I call it the China syndrome, where you got one thing trickling. If you look at the China economy, despite all of their efforts to, I will say, manipulate it to make to stabilize it, and really what they're doing is they're kind of putting some deflationary pressures out there, and I'll call it in the world. By,
Yes.
When their economy slows down, all of a sudden they don't need as much petroleum products so the price of gas, there's all of a sudden there's a glut here, and they're not going to be buying as many other products. So all these different chain reactions go boom, 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 and then all of a sudden from somebody in the annuity world are like, oh, what's happening to these guarantees? And the funny thing is, right now might be the best time from the guarantee standpoint, because those might actually pull back even further.
Exactly. The annuity industry has proven through this whole financial crisis that they can be extremely resilient.
Yeah.
Folks that have been in annuities have done very, very well overall in terms of protecting their money so it doesn't go backwards, getting some good, reasonable growth. And even more importantly are the income guarantees, for those folks that need a pension-style income.
Right.
It's built into those annuities. But exactly what you're explaining, when China or Greece or any of Europe, any of these countries that are major players or groups of countries.
Or minor players in Greece's case, no offense, Greece. But
that they start putting this pressure on, these annuity companies have no choice but to start saying, how can we pare back a little bit on our guarantees and our benefits?
Well, and it's protecting the clients is really what they're doing. They're not going to put the company at risk, and so they're protecting their policyholders, those people that own annuities. They're not going to let you lose money. So they're taking the safeguards necessary to protect the profitability of the company and preserving the client's assets.
Yeah. Well, I was just going to say, folks, that is an insurance company's number one responsibility is to protect their current clients. And everything that they're judged by from a regulator's point of view is, are those policyholders being protected? So they're way more likely to cut benefits for those coming into new policies, new annuities.
Right.
And we have seen that the vast majority of these companies really do play fair in terms of protecting their current policyholders and holding higher cap rates for people who got in when guarantees were stronger, giving greater participation, better spreads. And so there's some great advantages, as in all timing, if you actually can see that there's a lot of volatility, on the horizon. I believe, Eric, we've only scratched the surface in what's about to happen. Economists all over are telling us that we're really set up for a 20 to 40% correction. And I think that, folks have to stop and say, can I afford that?
Well, and I think we've talked about what annuities do in the sense of providing the income guarantees. But if someone's looking at it from a perspective of well, I need some growth. Well, if you look at the sequence of returns in retirement, really it's the return of your money that's really the most important aspect, and making sure you don't have that significant drop. So if you're taking withdrawals, even from a stable account balance, and you're not going to go backwards, you have the potential for a gain, but without going backwards due to basically a poor investment correction or anything of that nature, you can survive it much more likely in retirement, especially in those first few years. Nobody wants to go into retirement right now
Right.
and experience a 40% drop in their portfolio.
Exactly.
And that's what this type of plan will allow you to kind of weather the storm.
And what we have seen in experience with the annuity companies, during the last major financial crisis, is when folks were really going backwards, really losing money pretty consistently in 2007, 2008, part of 2009, we actually experienced clients having some pretty darn good gains. Yeah. And that's one of the things that folks don't understand about indexed annuities is that when markets are dropping, they may have one year where they don't make money, but they'll have other years where they make very good money. And it averages to where not only are they not losing, but they're getting a reasonable rate of return. And I think one of the most exciting things has been some of the newer indexes and some of the newer strategies where they're not capped.
Right.
And where they have a unique index. We were just looking at an index the other day on one of these, Eric, and you even sent it out to a client to look at that actually showed that during the last few days, they made money.
Yeah.
That index made money.
It actually.
So when we were, go ahead, tell us.
I was going to say, well, it's just simply, there are indexes out there that will actually perform positively even when the market is correcting. So.
They're a non-correlated type of an index, and so they're not going to maybe compete with the S&P in a strong bull market, but in any kind of an average market, they could do very well.
Exactly, and that's what you're looking for. You're looking for something that will preserve your assets, protect your retirement, and protect what you have for the next 25 years.
So, Eric, when we say China effect, what are we really saying?
What we're saying is that, when the world sneezes anymore, or any country sneezes, the whole world gets a cold, and our economy is no different. You're going to have volatility.
Yes.
What's the best thing you can do? Look at an annuity or look at something to take that volatility out of play.
Exactly.